I don't think 12%, 14% is a bad return. At 12%, you double your money in 6 years. At 14%, you double your money in 5 years. It's great. In 20 years, we'll have more Warren Buffets in India than in US.
No, but I want 10x in 10 years.
Then you should buy crypto and gold and then pray.
So you're saying it's not possible?
You have to be really, really extraordinarily smart. And if you come across a person, I will make him a fund manager here. The only problem is everyone wants to become extraordinarily rich overnight. And then what you do? You aspire to make 25, 30%, 40% return. Then that's why the option trading is so high. 99 out of 100 youngsters are not investors, they are traders, and that is recipe for disaster.
I invested about 1 crore in your fund about 2 years back, and today it's at 1.4 CR in just 2 years.
If someone doesn't want to complicate their life, there is no easier equity investment instrument than a mutual fund scheme.
Could you have not invested in gold in your fund as well?
I am not a believer in gold, and I've been wrong always. I have not come across a single fundamental report justifying gold prices.
How do you manage your own money? What is your own asset allocation?
So I have gold because I'm married.
Okay. What would be your advice for someone who wants to get 20, 25, 30% returns? Let's start with my own investment. So I invested about 1 crore in your fund, which is the all cap fund. About 2 years back, and today it's at 1.4 CR. So we have grown it by 40% in just 2 years. And I also looked at your overall fund performance since inception. It's been about 5 years since you've started. And I think the CAGR is around 25% CAGR. And if you compare that with the benchmark, 20% CAGR, right? So you've given an alpha of 5%. And to put that into perspective, if somebody is investing, let's say 50,000 rupees a month, and increasing by 10% every year as an SIP over 20 years, the alpha that they can generate, with a 5% alpha is almost 75% more money, right? So that's the kind of, value proposition you bring. So first I want to ask you about your sector allocation. Today, as I see your fund today, about 20% is in banks, 10% is in steel products, and about 7% is in pharmaceuticals. So that's the top 3 sectors that you're investing in. So can you tell us about your rationale behind that?
I think we are very clear. We want to be fundamental investors.
Yeah.
And therefore, anything which we do has to be looked at it from a balance sheet, profit and growth perspective. So that is one thing. Second is, as far as sectors are concerned, obviously, you have to have some sector allocation, but we are predominantly company-specific investors.
Okay.
And then the sectors built up.
Okay.
So if you look at the current allocation, I think financials are a big component of our economy, also a big component of the markets. And we also are pretty positive on that segment.
Right.
But the whole, I would say the composition of financials itself has changed dramatically.
Interesting.
Earlier, financials used to be only banks. Now financials are banks. You have NBFCs, which is non-banking financial companies. You have non-fund-based financials.
Okay.
So companies like wealth managers, asset managers, exchanges,
Right.
depositories, investment bankers, brokers, insurance companies, and some fintech.
Right.
So in fact, if you go deep down, our exposure to financials will be almost 30-35%,
If you include all of these
all
things.
of these. And I would say increasingly, that segment is going to grow faster. So that is one aspect to it. Second is, by nature, we don't get constrained by any, I would say, predetermined notions. So there are investors who would say, we'll not invest in cyclicals, we'll not invest in metals, we will not invest in high capex kind of companies. We are pretty okay with it. As long as the ROC, ROE and all the other matrices of fundamentals are in place,
Right.
we are pretty okay. And that's why, we have even metals in our portfolio. The
Right.
only thing we do is these are deep cyclical sectors. So we don't go beyond 8-9% typically in these sectors because, these can be very, very volatile. And obviously then there are sectors like pharma and so many other sectors where India has inherent global competitiveness. So despite the near-term noise of tariffs on pharma and not tariffs and so on and so forth, I think we believe that where India has inherent competitiveness globally, I think those sectors will eventually grow pretty fast.
Got it.
So I think in short, and just trying to understand why these allocations are there, but
Right.
and we are very benchmark agnostic. So we have zero exposure to oil and gas, for example. So the largest company in the oil and gas, which is almost 10% weightage, we have zero exposure. We have zero exposure to consumer staples because the growth is not there and the valuations don't justify. We have cut down our exposure to IT services side quite a lot.
Why?
Because again, we believe that growth there is going to be maybe maximum 2, 3, 4%. And there are a lot of headwinds with AI coming in,
Right.
H1B visa issue, and so on and so forth.
Right.
And valuations are still upwards of 20, 25 times.
Right.
So, we do take those kind of bold calls also. Sometimes it works, sometimes it doesn't work. I think as long as they work more than they not, we are fine.
So basically, in summary, the bet for the country right now is for banking and finance because you feel like the disposable income will keep increasing, so people will have more financial transactions.
And valuations are pretty okay.
Valuations are pretty okay. Then you also have investments in pharmaceuticals. Now, pharmaceutical, do you feel like it's very, very nascent right now in India? Because if I compare with, let's say, the US, the pharma industry is much larger part of their index, whereas in India, it's a very minute portion. Do you think that is like one of the dark horses for India that's about to explode?
So, Sharan, you have to, again, pharma is a very broad term. Within pharma, you will have various segments. I would say hospitals, diagnostic centers would also be a part of pharma and healthcare.
Correct.
Within pharma also, there are various opportunities. Now, coming to the domestic pharma, which you are referring to. So, actually, if you see, the penetration of pharma in India is still very, very low.
Correct.
And affordability is increasing. Plus, awareness of taking insurance is increasing. So, the ability for general people to pay for healthcare, awareness is there, now ability to pay is also there. And therefore, if you see, domestic pharma also keeps on growing at 8-9%, which is more than the soaps and shampoos.
Right.
And valuations are much lower than some of these so-called FMCG companies.
Correct.
So, our bet is that if you want to play the domestic consumption play, domestic pharma will be better than some of these FMCG companies.
Interesting.
And globally also, Indian pharma companies are quite competitive. So there is a drug called Revlimid, which used to do $16 billion worth of sales in North America.
Okay.
And the generic version was launched. The value fell from $16 billion to $500 million.
Wow.
And even in this $500 million, Indian companies were making 90% margin. So that is a cost differential between some of these products. I'm just giving you one product because it was so large.
Yeah.
All of them will not be as large, but there's that kind of opportunity. And as I said, Indian pharma is globally competitive. So there's a lot of potential there.
Well, that's interesting. It was a $16 billion market. Then a generic version came from India. It became $500 million market because the price came down.
Yes.
And even on that, Indian companies were making 90% profit, which means it was so expensive there in the US.
Right.
And then the generic version came and disrupted it.
Right.
Interesting. So, and the last sector you're saying is steels, right? So what's metals and steel. So what's the logic behind that?
So again, I think this is one sector where Indian companies are globally competitive. We have full backward integration. We have own iron ore, we have our own power, including coal. We have our own market also. And we are going to be the last man standing. So in metals, you can again divide it between ferrous metals and non-ferrous metals. Non-ferrous metals typically tend to be more global.
Okay.
So like the coppers and the aluminiums and the zinc and the nickel, because the prices are, determined globally on the LME, the London Metal Exchange and all. There also, I think if you see the price trend, prices have been moving up. A weak dollar has led to gold and silver shooting up.
Correct.
Metals are catching up a little bit. I'm not saying they'll shoot up, but there is a thing. And once the world becomes more peaceful, which it is becoming, there will be reconstruction. So there will be obviously, demand for metals coming in. Steel is more a domestic commodity.
Why does India have an edge over here, over the world, with respect to metal?
We are completely integrated. As I said, we have our own ore, we have our own energy.
Okay.
So China is the largest, but China doesn't have any raw materials. Okay. They have their energy, but they don't have iron ore, they don't have bauxite, which is all needed for making the final metal. And I think Indian companies, to that extent, are fully integrated.
Got it. Also, sir, it is said that to build true wealth with active investing, the game is about taking concentrated bets, right? Not investing in hundreds of different companies. And that is where I think a PMS differentiates itself from a mutual fund. A mutual fund typically might have 50 to 100, 150 companies. But I think your particular PMS has only 25, 30 different stocks. But if I go deep dive, even though these are the top 3 sectors, you have still invested in sectors like, for example, paints, paper products, power, specialty chemicals, sugar, and all of that. What I'm trying to understand here is that if we want to take concentrated bets, why are we diversifying with 10 different industries? What if at a certain point of time, let's say I know that the next 6 months AI is a trend, right? Or pharma is a trend. So I'll only focus on those sectors and invest. What is the mistake that I'm making in assuming this way?
So it works both the ways. You can have a concentrated portfolio and do very well. But on the flip side, if that doesn't work out, you'll have no returns.
Right.
So investors generally want consistent, good returns. They're not looking at 100% return 1 year and then 3 years no returns. So I think concentration is good, but over concentration can also have pitfalls. And things necessarily might not go the way you analyze it and the way you view, because there are so many external factors also. Like for example, tariff. Now suddenly Trump came and said no H-1B visas, for example. And if you had 100% of your investment in that one sector, you would have been like butchered.
Correct.
So I think it makes sense to diversify. I would say how much you diversify will depend on what you have communicated to your investors and what is the risk profile of the investors. So we do have concentrated portfolios where we have only 6 to 8 stocks.
Okay.
But those are like really large investors who understand.
These are AIFs.
PMSs.
PMS is one.
Yeah. But
With
the
only
minimum
6 to
ticket
7
size is 25 crores because we want very seasoned investors there.
You have a PMS which has minimum investment size 25 crores. What is it called?
Personalized opportunity specific strategy, POS.
POS, okay.
Yeah. So, but there it's very clear. The returns will be lumpy.
Okay.
Because, if you have only 6-8 stocks, if 2 stocks don't do well in the near term, your returns will really come off. If they do well, your returns will be... But those are for seasoned investors who understand it. Most of the PMSs are with investors who want alpha, but more consistently. And therefore, we have some diversification. Obviously, mutual funds will have 80-90 stocks because the sizes are so large. And their investors they have investors who have given 1,000 crores to invest, 1,000 rupees to investors who would have put 30-40 crores also.
Correct.
So I think depending on your investor base and what you have communicated to them, you'll have, diversification or concentration. As far as the industries are concerned, I think, as I said, we are more bottoms up. So the best sector in the worst industry might give you returns.
Right.
And the worst company in the best sector might not give you return. So the way it is important that you pick the industry, it is also important that you pick the right stocks. And our focus is predominantly in picking stocks.
So if I look at the options of investing that a retail investor has, obviously the easiest one is a mutual fund, right? In a mutual fund, in the last 5 years, it has given anywhere from 15 to 20% CAGR. A PMS investor can typically expect what percent of alpha over a mutual fund investor?
A very difficult question. So I would again very clearly say that mutual fund is the simplest investment instrument. So those who don't want to complicate their lives, for them mutual fund se acha kuch nahi hai. It's the best thing to do it. PMSs will have advantage, PMSs or AIFs, of few things. One is smaller size of the fund, so more easily manageable. So, our largest PMS would be 4,000-5,000 crores. The largest mutual fund scheme will be 1 lakh crore.
Correct.
So, the ability to maneuver is to that extent restricted. The other thing is obviously over diversification, as you said. So, if it's a 1 lakh crore fund, they will have 80, 90, 100 stocks because, you won't get liquidity.
Correct.
We can have slight concentration of 25, 30 stocks, which also helps. Third is, in a mutual fund, it's professional fund managers who might change because they can change jobs. In a PMS, you're looking at the guy who set it up, and you know that as long as the firm is there, this guy is the one who's going to manage your money.
Correct.
And I think the fourth thing is you have more communication compared to, say, a mutual fund in terms of, at least having, like we have monthly webinars and, some of the larger investors even come and meet us and all those things are also there. But as I said, if someone doesn't want to complicate their life, there is no easier equity investment instrument than a mutual fund scheme.
No, I understand that. So when a person begins their investing journey, the first 2 years, 3 years, 5 years also, they are okay with the mutual fund investments. It's probably making 15% CAGR and they're like, okay. But then that itch comes. You know what? 15% is not getting me to my financial freedom fast enough. I want to generate 20-25% CAGR returns. Now I can't afford to give 50 lakhs to a PMS fund manager because he or she is telling me that they can beat the index by another 5%, 6%, but I don't have 50 lakhs to give them. What would be your advice for someone like this who wants to get PMS-like kind of return, which is 20, 25, 30% returns, but needs to actively manage their portfolio by themselves?
So one is, I'll just first come to that 20, 25, 30% return. I don't think that is going to be possible going forward.
Or going forward, not possible?
I don't think so.
In anything?
If it happens, we should consider ourselves lucky. See, the growth rate for India,
right,
the nominal growth rate, the real growth rate can be 6.5%, 7%. The nominal growth rate has come off from 13, 14% to 9, 10% because inflation has come off. So obviously, if the nominal growth rate is 9, 10%, your corporate profit growth can be 2, 3% more than that. It is not going to be 17, 18% the way it used to be earlier.
Sure.
The other thing, we are not as cheap as we used to be earlier. So this 20, 25% return which you see even in our schemes over the last 4 years, also because there are so many stocks which had become very cheap.
Right.
I think we are not in that era where
Correct.
Stocks are very, very cheap. And the third thing is, if your alternates like fixed income are going to give you 4.5% post-tax, you can't have equity giving you 20, 25% return, So one-off year it is possible,
right,
but I don't think from a 4-5 year CAGR perspective, those kind of returns are going to be possible in the listed equity space.
Sure.
Now coming to PMS versus mutual fund, obviously our existence will depend on getting some alpha.
Correct.
Otherwise we will not exist.
Correct.
I think from a investor's perspective, if you have limited resources, I would again reiterate that there is no better instrument than mutual fund. Now, I don't see any instrument which can give significantly higher return than a mutual fund. And mutual funds are giving good return unless you start to trade on your own, which is something which I would never recommend.
Okay.
Otherwise, I think you should be happy with it.
You're saying you wouldn't recommend someone buying individual stocks by themselves?
They should first be full-time into this.
Okay.
Second, they should have the kind of resources we have, which is 8, 10 analysts. They should have the time to do it on a regular basis. So then they will be professional investors rather than
part-time investors.
And then they should have resources. You can't have 50 lakh, 1 crore rupees and say, I'll be direct investor. Then you have to have 500-700 crores because then you will be able to afford hiring 8-10 people to manage the portfolio.
So, but you're saying as an individual investor, if I, let's say, give 4 hours per day to do my research, to identify what individual stocks to pick, and because I feel like if I can manage my, let's say, 10 lakh, 20 lakh portfolio by myself, I might be able to take some concentrated bets based on my research, which a mutual fund will not do because mutual fund is investing for everybody. So if I actively manage my 10 lakh, 20 lakh portfolio by myself using my own research 4 hours per day, you're saying that's not going to work out?
Then you have to be really smart to do it.
What do you mean by smart?
If you believe that you can do a better job, then all the professional outfits and the huge research team, then you should do it. But normally it doesn't happen. What then you end up doing is to trade. Because you'll hear from someone that this stock is good, something is happening, and then all the research goes on the back burner. Correct. And you'll say, le leta hu main. And it's a 50-50% rule. 50% of the time you'll be right, 50% of the time you'll be wrong. But the problem is when you are right, you book profits when the stock goes up 10-20% when you're doing on your own. When you're wrong, you don't want to sell it at a loss. So typically then your portfolio comprises of stocks where you have gone wrong, which is the worst thing to happen. So as I said, if you are confident that you can do a better job than someone who is doing a good job by charging only 1% fee, then you should do it.
Right.
But I would say significant majority would underperform the professional portfolio managers.
So then how did you become so good? You were an individual yourself in the beginning. What were the things that you did to become where you are today? Right? If an individual investor needs to aspire to become like you one day, what can they do?
So one is obviously you need to have a proper organization.
Okay.
So even when I was in Reliance Mutual Fund, we had a proper organization. When we set up Abakkus, the first thing we did without zero assets was to build a good team. Obviously, we that time had 8 people in the investment side. Now we can afford it. So we have 20 people on the investment side because you need that. Second is we have learned by making mistakes. So this 25, 30 years of making mistakes
Right.
has contributed to ensuring that we make less mistakes. Even now we make mistakes, but we'll make less mistakes from compared to someone who's starting afresh. And third is it has to be a full-time profession. It cannot be a part-time thing. You can't say that I'll work for 2 hours and do investing and then, I will beat everyone.
Saying not possible.
Yeah. So what I would suggest is even if you want to do direct investment, I think don't put 100% of your corpus in direct investment. Maybe you carve out some portion
Right.
and say that I will reserve this for something if I get high conviction on. So I always say that suppose if you are in chemical business, you will have more insight about the business.
Correct.
Somewhere that this chemical prices are moving, this company is doing well. Maybe if that knowledge you can transmit into buying something directly,
Right.
then you will be more right than wrong. But if you're just sitting and watching media and someone coming on TV or someone in the party telling you कि खरीद लो कल बढ़ जाएगा,
Right.
then it is thrill.
Right.
It is not creating wealth.
Right. Makes sense. Makes sense. So I was just going through your investment strategy. You have something known as the MEETS framework. I wanted to go through each one of them so that I can better understand it through you with some interesting examples.
Sure.
One thing which caught my eyes is capital allocation. You said capex is fine if ROE is maintained. Like, can you give an example of what that means?
So I mentioned to you earlier, there are some sectors which a lot of investors avoid because they are capital intensive sectors.
Yes.
So how do you determine whether management is good or bad? So there are softer trades, Harvard educated, Stanford educated, great management. Maybe rest, maybe not. Wearing good clothes, great management. Speaking well, maybe great management. But we are very number focused.
Right.
So our view is that the biggest thing which will determine a good management is, I would say, discipline in terms of capital allocation. How much are you going to allocate to the business and how much return are you going to make out of it? So unless the ROC is at least 14, 15%, we don't invest. And this is what we mean. So, say steel. Steel, typically, investors don't invest because one, it is cyclical. And second is very capital intensive. So the ROCs tend to be lower.
Right.
But there are still companies within that sector which are generating 15, 16, 17% return on capital employed. They are very disciplined in terms of new capacity being added, and they even figure out that, how much is the payback period going to be. So our view is very clear. Unless the ROE is at least 14, 15%, we will not invest.
Got it.
That's why there are so many large companies which are a part of the index, which we don't own, because the ROE in those companies are like 9%, 9.5%.
Got it. So you're saying if it's not about 12% return on capital employed.
Because then, if they are not making money for themselves, how they'll make money for us?
Makes sense. Meaning their profit as a percentage of their capital should be more than 12%. Otherwise, why as well put in...
The cost of capital in India is at least 9-10%.
Correct.
So unless you make at least 3-4% more than that, how are you going to continuously keep on adding value to the business? See, investing in an equity is becoming partner in the business. That is the core philosophy we have. So everything will resonate with that. Whether you will become a partner in a business which is generating 9% return.
Got it. So the next thing you look at is earnings. And one of the things that you mention is quality of earnings versus reported numbers. Now, whenever the quarterly report comes out, we will see the EBITDA and all of that. So that is the reported number. You've written something known as quality of earnings. What is the difference between quality of earnings and actual reported numbers?
So companies generate profits and companies show profits. We want to focus on companies which generate profit. Luckily, I think corporate governance in India is improving. And therefore, these kind of mishaps have reduced. But even now, there are corporates who take the shortcut route of reporting profits rather than necessarily generating profits. So cash flows become very important. And I think these are very technical things.
Right.
We do a lot of balance sheet analysis, and our view is that we end up at least preventing mishaps in the portfolio. See, you will always have scenarios where the stocks you buy has gone down because of things which you thought would happen have not happened, or the market conditions and all. But not on fundamental basis. It's not because of fraud that the stock has gone down. And I think that is very, very important, particularly in this world where everyone is looking at fast growth of market cap.
Right. So the third thing that you look at is events, right? Now, events, the way I look at it is that, okay, there is an AI wave going on. The US dollar is getting depreciated. So, hard assets like gold is going up. So these are some kind of events which are happening. Now, if I look at your funds, you've not made allocation in these kind of sectors. So can you explain how you look at events?
So it is event trends and disruptions.
Right.
So the way we work, the way we study, the way we shop, the way we entertain ourselves has completely changed. Market price of a stock is equal to EPS into P.
Okay. Earnings per share into price to earnings ratio.
Right. So if you have a 20 rupees earning and 50p, the stock price will be 1000. It's a very simple.
Correct.
Anyone who's even a smallest investor would understand that.
Yes.
EPS is a function of how you manage your business. P is perception. And more returns on either side, upside or downside, are made because of this perception change rather than earnings change.
Okay.
So for example, newspapers, huge moat. If you have grown up reading Times of India, you will read Times of India only. But advertisements have shifted because my kids don't read newspapers. They tell me that you are reading yesterday's news. So advertisements have changed.
Right.
So P multiples have collapsed. Same is the case with entertainment. Now, at least I don't see the traditional channels which were there earlier. We have moved to the Netflix and the OTT platforms of the world.
Right.
And therefore, the traditional channel Ps have dropped significantly. In India, auto has not seen that, but globally it has seen that. Tesla trades at 200p. But BMW, Mercedes, Stellantis, Volkswagen, they trade at 6-7p.
Wow.
Because, the perception is that
Transition
we will move to EV.
Correct.
So the perception change basically becomes very important here. And we have to be aware. Because gone are the days where you could buy something for 30, 40 years and forget about it.
Correct.
Now, coming to this new age sector, the reason we have not bought it because they don't qualify. They are not profit making and they don't generate ROC. But at the same time, we are aware of the fact that this $4 trillion of Indian economy, when it goes to 8 trillion, it will be contributed by very different sectors. So we are researching them. And it is possible that we will end up buying few of them, maybe at a higher price, but when they qualify in our framework. But this event trends and disruption is predominantly what I told you, whether some sector can be disrupted both on the positive side as well as the negative side.
But do you also not feel like, I wish I could invest in the US market? There are companies like Nvidia and Tesla which are getting into, new all-time highs almost every single week.
Yeah, we can't invest.
You can't invest. Right.
And we don't have expertise. Why would someone give Sunil Singhania funds to invest in US when I have no experience?
Right.
They would rather give it to someone who has experience of investing in US markets, right?
Right.
And plus regulations are also very onerous. So how much can you invest? $250,000 a year?
Per person, yes. And what about commodities like gold, right? Could you have not invested in gold in your fund as well?
I am not a believer in gold and I've been wrong always. See, gold...
You're not a believer in gold?
Like, I have not come across a single fundamental report justifying gold prices.
Right.
Have you come across any fundamental report?
There's no way to justify the gold price, right?
So the reports say that central banks are buying.
Correct.
Retail is buying. There is shortage. Technically, it can go to 5,000.
They're saying that about silver also,
no
right?
Fundamental way you can say that gold prices should be $2,000 or $4,000. 1 year back, gold was $2,000. For 3-4 years, the price was same. After the initial COVID jump,
correct,
the price was same.
Correct.
Why were we not talking about it then?
Because now it's booming by 60%.
So, exactly. So there is no fundamental way of valuing gold. And therefore, I don't have any edge. At best, if someone comes, बोला 5% ले लो gold. So guy feels happy.
Right.
But I don't have a fundamental basis of justifying the price of the gold and also justifying how much percentage you should put in gold. The other thing is, suppose you buy 100 grams of gold today. After 20 years, what will you have? 100 grams of gold.
Yes. Quantities will be the same, but
It doesn't give a dividend.
so
It
one
doesn't
way
grow.
of what I've read online is that, let's take the example of silver, right? Silver has real world applications in the booming technologies that we are seeing here, right? Like EV, battery technology, they're using silver a lot in it. And if the amount of silver that is made in the whole world in a single year is significantly less than the demand for it. Now, there is no alternative to silver also. If there is an alternative, I'm like, okay, that's not there, I'll take something else. No. So if there is a demand for a limited asset, by logic, shouldn't the price be higher and going up? And can't we ride that wave until that demand keeps
Is
sustained?
this something which you have come to know in the last 1 month?
I mean, because the prices have gone up, people are now
This was
researching it
always-
and studying it.
This was always there, right?
Right.
You're talking about it now because price has gone up.
Correct.
The other thing I'm telling you, I remember few years back, zinc prices shot up.
Correct.
And when you galvanize steel, you galvanize steel so that it doesn't rust. Zinc is used to galvanize steel. Companies discovered a way where they were mixing aluminum with zinc to galvanize steel. It was called galvalume.
Okay.
So there will be innovation. If prices become too high,
They'll come up
there
with
will
something.
be innovation where it will say, okay, instead of using 10 grams of silver, I'll use 5 grams of silver and mix it with something else. I don't know. But what I'm trying to tell you is all these stories are coming now. Why were they not coming 1 year back or 6 months back or 2 years back? Silver yesterday touched an all-time high of $50. After how many years?
I
You
don't
know
know.
that?
How many years?
45 years.
Okay.
In 1980, silver was $49.
Really?
And yesterday it touched $50.
Wow.
In rupee terms, you can argue because rupee has depreciated. In 1980, rupee was 10 and now it is 88. So it has
Correct.
gone up 9 times. But these are the kind of long cycles. After 45 years, it has touched its previous high. So no one talked about silver in this interim period. And now you're all talking about silver or gold. As I said, I am wrong because gold has done so well.
Yeah.
But what I'm saying is fundamentally, I don't know whether the value of gold can be $2,000 or $20,000. It is all technical and demand supply and central banks buying and so on and so forth.
Right. So, sir, personally, then if I have to ask you, how do you manage your own money? What is your own asset allocation?
So I have gold because I'm married.
Okay.
So my wife buys gold and her name is Kanchan, which is gold. But I would say I have some fixed income. I'll be
Okay.
very honest.
Like if you can give me a percentage split, like out of 100, what is the percentage split in all the
So
different
in
assets?
terms of free assets, what I mean is that investable assets, I
Liquid
would say
assets, without considering your home
my
and all of that.
equity would be 75%, fixed income would be 25%. But when I take the value of my business,
No, that's different. That's billions.
no, but that is also equity,
Of course. Of course.
So
Right.
technically that is also equity, right?
Right. No, I wanted to give it in a relatable way to the audience. Not
Yeah.
everybody has
So
a feeling.
75% would be still equity.
75% equity, 25% debt. So you don't invest in apart from your home, don't you look at real estate investments like commercial
I
property?
have, frankly, some investment,
Okay.
but I have never seen it that perspective. So what we do is basically like the offices we own,
Okay.
So then they are leased to the company because...
Correct. So that becomes a passive rental
yeah.
income.
So I have not calculated that, frankly.
Got it. And what about crypto?
I don't understand it.
Okay.
At
But
the same time...
have you tried to understand it?
No, I understand the logic behind crypto,
Okay.
but I don't understand the value of crypto.
Okay.
So I did courses to understand, the crypto. But the only thing I'm not able to figure out is how do you value crypto?
So this is one way I want to look at it. If you look at, let's say, the currency right now, the US dollar has been overprinted so much and that inflation has been imported to India. People like us, something that we used to pay 100 rupees for 5 years back is literally 200 rupees right now. So the trust on the currency has gone down so much because of the overprinting by the government. The promise of a cryptocurrency is that they will not let it be overprinted. Like you cannot make more Bitcoin than the number that has been assigned to it. So isn't value to something assigned based on the limitation of what is there? Similarly, if you look at, let's say, for example, a stock, for example, if a company whose stock we're talking about is doing something which every person can do, then that company won't be valued a lot, right? If it's doing something which has huge barriers to entry, very difficult to do what that company does, that company will be valued a lot. So by that same logic, can't we say that a Bitcoin or an Ethereum should be given a little bit more importance than a dollar because the US government is doing whatever it wants?
So I'll respond first to the company perspective. See, companies, when you invest in, as I said, we become partners in the business. They're growing businesses. Some would grow faster, some would grow slower.
Right.
Companies which have a moat where not too many people can come in will grow faster.
Correct.
They will get a higher P, the higher perception.
Correct.
Companies which have too much of competition coming in will grow slower and they will have a lower P multiple. So there is a rational way of, over a period of time, analyzing that what this company should be worth. The same logic we cannot apply for crypto. So you're right, crypto will be limited. But tell me, if the price falls to 1 lakh or the price goes to 2 lakh, do you know how to react?
I don't know how to react, no.
So that is exactly what I'm trying to tell you. The same goes for gold also. So all the logic of de-dollarization is true. And that is the reason they have moved up.
No, but what is your opinion on what the US is doing? You know, they have a $37 trillion debt. Now they are trying to rebase it with the tether, you know, the US dollar tether, which is a stable coin. And what sources are saying is that, no, they're trying to offload that debt to people holding US dollar tether. How do you look at something like that, which is done by the largest economy of the world?
So one is, I think what is happening in US right now is something I don't think is going to continue forever.
Okay.
It's a transition. There's one person who is trying to do a lot of things. Second is, US is a beneficiary of the fact that there is no other currency in the world where people have more confidence. If we had euro, which would have been more stable, or if people had confidence in China,
right,
maybe instead of moving to gold and crypto, they would have moved to
correct,
some other currency.
Correct. I agree.
So, you know, they are getting that benefit out of it. Now, $37 trillion is very, very worrying. But even 30 was worrying. Even 25 was worrying. You know, and simple hai. If you spend more than what you earn, what is going to be the outcome?
You'll have a loan, debt to pay.
At some point of time, you will default.
Correct.
But whether that time is going to be in the next 6 months or after 10 years, that you don't know. I think I'm very sure the way we are worried, US would be more worried. And maybe some reason why Trump is doing Make America Great Again and putting tariff barriers and all is to little bit take care of that. His way of doing it is very unconventional,
right,
very illogical. So we don't know. But I think ultimately US will have to have lower interest rates. Otherwise, it is going to become increasingly difficult for them to manage this. Fair. So, you know, at 37 trillion, if you pay 4% interest, it is $1.5 trillion annually. If you pay only 1% interest, it is only $400 billion annually.
But then they have to also control the inflation.
Yeah, so that is very, very tricky, you know. So I think economics is not very easy. You know, it's not only one factor, but it's a combination of a lot of factors which determine how things are going to progress.
So then, if coming back to India as a whole, what do you think, 2030? What's going to happen? Like you mentioned right now that Indian multiples are very high for the companies. You're not going to see the post-COVID returns that we just saw. So if that is the reality, what should a retail investor do? Just accept the fact that I'm only going to be investing in India and make 12% returns? What is your way of looking at it?
So GDP growth of 6.5, 7, we think is possible. 3% inflation definitely is going to be there. So 9.5, 10% is going to be a nominal GDP growth. And I think large caps, profit growth will be equal to that. Okay. And maybe returns will also be 10, 12%. The broader markets, the smaller companies are in niche segments. They can grow slightly faster. And that is where we believe that a 14, 15% return is possible. With P multiples not expanding, not coming down. P multiples are at 18. We are not building in any return out of P multiple expansion. I think India to some extent stands out because 6.5%, any other country would die to grow at that level.
Right.
You know, I don't think any country, at least large economy, is looking even closer to 6.5, 7%, and that we are there.
But this is mainly because of our young population.
Young population, low base, you know, we still have so much to do.
But why do you think we've fallen behind China? Right? Because 20, 30 years back, we were at the same place as China. But today we are, China, I would say, is a developed country, right?
We are a democracy. We have to take everyone together. To build a road, you have to take permission from 50,000 guys who would be affected with that road. In China, you don't have that. They will one day come and say, you just have to move out of that. So that is one thing. Second, obviously, I think we have to give credit to them. They have done a lot of things very well. For example, I remember when we bought something, और वो खराब हो जाता था. वो बोले China का माल है. They have grown from there, from making duplicates and substandard products. They have graduated to being the best in the world. We have to give it to them. The infrastructure. I think we should learn from them. And to some extent, I think we are getting there. You see our airports.
Right.
See the metros.
I mean, airports are great. Man.
Yeah. So wherever we have put our mind to, we've been able to do it. Now, metro is taking time, but jahan bana hai, at least they have done a good job. Now we hope and we pray that all these political issues are behind and things get done faster. We're all sufferers. It takes me 1.5 hours to travel 12 kilometers. Like crazy.
Right.
In Bombay, we don't talk in terms of miles or kilometers. US mein jaate hain to bolte hain na 5 miles away. We say we are 1.5 hours away. So there is a lot of improvement to be done. But wherever we have put our mind to, we have been able to do well. And I think this whole Make in India, encouraging production, manufacturing in India, I think that will eventually turn out, I would say, true. So from a retail investor's perspective, I don't think 12%, 14% is a bad return. If you're going to make 4.5% post-tax and fixed income, it will take you 16 years to double your money.
Correct.
At 12%, you double your money in 6 years. At 14%, you double your money in 5 years. It's not bad. It's great.
No, but I want 10x in 10 years. 26%.
Then you should buy crypto and gold and then pray.
So you're saying it's not possible with active sector rotation within equity market?
You have to be really, really extraordinarily smart. And if you come across a person, I will make him a fund manager here.
Good. So consistently you're saying getting the 25.
Seeing your podcast, I'm very sure I'll get 100, 200 resumes now.
Amazing. So, sir, as a lasting note, what advice do you have for the young investors of our country today? Today we are at 16 crore demat accounts and fast growing. So more and more people are entering this ecosystem, but they don't have the, the guidance or the advice because money is one such thing that, even if there is a very old person in your family, generally wisdom is connected to old people, but it doesn't really matter, right? People who invested back in the day are not giving us good advice these days. So what is your advice for people investing from now on?
So I'll give you a little bit of a longer answer.
Please.
When I started my equity market career, it was like 1997 or 94, I don't remember, 94. That time we used to think that, people who were earlier, they were so lucky. They got that big move of that.
Yeah.
I'm very sure investors were joining now, professionals are joining now, they must be envying us. In log to lucky the, economy was small, it was so easy to make money.
Right.
That's why they have been successful.
Right.
But I just give you the same logic that the first trillion took 65, 67 years to reach 4 trillion took 77, 78 years. The next 4 trillion is going to happen in 8, 10 years. So imagine the wealth which was created over the last 77, 78 years. Same wealth is going to be created over the next 7, 8 years.
So you're saying this is the best time?
The opportunity is huge. The only problem is everyone wants to become extraordinarily rich overnight.
Yeah.
And then what you do? You aspire to make 25, 30%, 40% return. You are very kind on an annual basis. People are here wanting to do it every weekly and every monthly basis. And that's why the option trading is so high.
Correct. The greed.
99 out of 100 youngsters are not investors. They are traders. And that is the disaster of, recipe for disaster. Because there is a concept called random walk theory. Even if you don't know anything, you will be right 50% of the time. If you flip a coin, you don't have to be an analyst, na? It is going to be head or tail. If you flip it 10 times, logically 5 times you will be right.
Correct.
So that is what trading is all about. And then you end up losing. I think for a young investor who is looking at creating consistent wealth, one, you have to be a little bit of a person who gives time to your investment. Second is, stay away from things which are looking extraordinary in terms of returns. I think they necessarily will have some issues. And third is, you have to be satisfied with good, reasonable returns. This day of 20% compounding, 30% compounding, 40% compounding are not going to be there on a consistent basis. You imagine if you grow 20% every 3.5 years, you double.
But the
In 20 years, we'll have more Warren Buffets in India than in US.
No, but the late Rakesh Jhunjhunwala sir did 66% CAGR for 4 decades.
That was, it was on a very low base. So if you start with 1,000 and you reach 100 crores, your CAGR will be 200%.
Okay.
So that's not a right way of looking at it, right?
Got it.
Even the Reliance Growth Fund, which I used to manage, just completed 30 years on 8th or 9th of October. It's delivered 23% CAGR returns over 30 years. That period, economy size was 100 billion, we grew to 4 trillion. This 4 trillion is not going to become 160 trillion. It will become 8 trillion, 9 trillion. We are large, That time inflation used to be 10-12%. Therefore, 18% return was easily achievable.
Correct.
Now inflation is 3%. So we have to look at it, on a comparative basis. FD rates were 12%. Tata Steel used to give 15% interest on their whatever bonds.
Yeah.
And that's why you necessarily had to make 20-25% return in equity to take that risk. Now it is 6-7%, and therefore you have to compare with that. So I think in the overall scenario, if you are disciplined and if you are very clear about good moderate returns, I think you will do well. And the other thing is trading, you do only if you think you are extraordinarily good at it. Otherwise, more people lose money than make by a big margin.
So basically, if you're going to get 15-16% CAGR, be happy with it because you're a passive investor.
I was saying lower, but it's fine.
What is the final number there?
As I said, I think mid-teens, you're okay.
Mid-teens is okay. 15-16% is fine. I said 14-15% is fine. But if you want to, really try your luck, and if you are ready to put in that hard work and effort, and if you think you're good, then you can start doing active investing.
There are some people who do privates, for example.
Yeah.
You have to be really clued on.
Correct.
So if you come across a really, really exciting entrepreneur like yourself at an early stage and you invest, you might make 10x returns also, which is what has happened in a lot of companies. But then you have to be really, really clued on in that segment.
Right. Cool. I think we've reached the end of the podcast. I think we've taken a little bit more time. But thank you so much, sir. I think this was a wonderful discussion. I learned so many things about how do we look at realistic expectations of building wealth in India. And thank you so much. Anything else you would like to add?
No, I think our tagline is believe in the basics. So we do very basic stuff, very boring stuff. But I was in Canada and I actually went into a large organization where the tagline was boring makes wealth. So if something is very interesting, beware.
Makes sense. Thank you so much, sir.
Thank you. Thanks a lot, Sunil.
All right, guys. On that note, I'll see you in the next one. Before you go, guys, if this episode gave you even one insight that made you think differently about money, don't just keep it to yourself. Share it with your friend or family member who could use it too. And if it sparked a new thought or even made you disagree with me, drop a comment below and tell me why. Your critique helps me make these conversations sharper and more useful for you. As long as you have me subscribed, I'll make sure that you walk away with at least one new thing every Wednesday.